Hello everyone. Exchange Traded Fund, shortly called ETF, become more familiar with the investors for the three main reasons. One is the simplicity, second one is it is an index fund, the third one is everyone can invest with a low price. But many people don't know how to select those ETF. So today we are going to check the 5 main points before you choose any ETF. Welcome to our channel Stocks in Silence. So the first point is, which index fund would you like to invest? There are many type of ETFs out there. Large cap equity ETFs, mid cap equity ETFs, small cap equity ETFs, then index like Nifty ETFs, Sensex ETFs. Apart from that index, debt ETFs, gold ETFs, silver ETFs, and foreign index ETFs, particularly for S&P 500 and Nasdaq 100. There are many type of index ETFs are there. So first we should be very clear about which ETFs we need. We should not understand all are same. Not like that. Each ETF have their own positives, and most of the ETFs are not index funds. That also we have to understand that. The next we'll understand that how many ETF funds as of now available in India market. 50 ETFs in large cap equity ETFs, 51 all other equity ETFs, 17 debt ETFs, 10 gold ETFs, and 3 silver ETFs are available as of today. The second, the important point when we choose that ETF is liquidity. The authorized participants is a large financial institution. They are just like an investment bank. Those people are purchase or sells shares required to create a unit of ETF based on the market demand. So when the demand of ETF is high, the authorized participants purchase more stocks and helps create more units of the ETF. So what we are understanding here is, it is important to choose an ETF that trades with a fairly high trading volume. This is similar to the investing in a liquid or an illiquid stock. If you purchase any stock, if somebody want to sell, then only you can able to purchase. Same way, if you want to sell or if you want to purchase, somebody have to sell. So for that, the liquidity is more important. If volume is more important, if you choose any ETFs without liquidity, then it is very difficult to sell and buy those ETFs. So it is very important to note down that liquidity. The third important point is price and NAV. NAV means net asset value. You know that ETF also is called as a mutual fund. So mutual fund is measured by the net asset value. At the same time, the stock is measured by the price. But here the ETF showing as a price as well as is a mutual fund, so we have to check that net asset value. The price of an ETF should move in tandem with its net asset value. Since an ETF is a mutual fund that trades, the NAV is the actual price of its unit. If the price is more than NAV, you are actually getting the ETF expensive. So always we should note what is the price and what is the NAV value. Hence, always see the price of an NAV difference at the time of investing in any ETF. The fourth point is tracking error. If any index fund, we should note down the tracking error. Tracking error is the divergence between the price behavior of position or portfolio and the price behavior of a benchmark. So theoretically speaking, any index fund, the tracking error should be 0, but practically it's not possible. But at the same time, we should look the minimum tracking error. For example, in the HDFC Index Fund, above the annualized tracking error is 0.07. It looks fair enough, fair good. This is an extremely low and healthy tracking error and is indicative of the fact that the HDFC Index Fund tracks the index very closely. So the tracking error indicates how well an ETF tracks its underlying index. The lower the error, always it is better. The last and very important point is expense ratio. In the case of actively managed funds, an investor may give performance or preference to the performance over expense, but in the case of ETFs, where the returns are almost certain to be like the underlying index. For two ETFs that track the same index, go for the cheaper one, provided that the rest of the determinants are the same. So it is also important, even active mutual fund or ETFs, always we should check the expense ratio. You know that many ETFs have different expense ratio, so it's very carefully we should note out. For example, if you go for Nifty ETF, the different fund managers, different fund houses have their own different expense ratio. That also very important to note on. If you are going to invest in the same Nifty ETF, then why do we give that more expense ratio? So we'll go for the lowest one that will give the long-term benefit for the investors. So quickly we'll sum up the 5 points. The first one is which type of ETF you want to choose. The second point is we always look the ETF which is having more liquidity. The third one is price and NAV difference, that also important to note down. The fourth one is tracking error should be as minimum as possible. The last one is low expense ratio. That's all, viewers. Thank you once again.